So today I want to do a stock comparison, a stock versus, if you will, between ROST and TJ Maxx. Now, these two discount stores are two of the most popular ones that exist, and also discount stores do well during recessions, and I believe our economy is due for a recession. So I'm going to look at these two stocks side by side, compare some stats, and just see how they compare against each other. So let's go look ahead. We have ROST, ticker symbol ROST, and we have TJ Maxx, ticker symbol TJX. Now, you have to remember ROST just has their stores as one brand, but TJ Maxx has TJ Maxx, Marshalls, Home Goods, HomeSense, and Sierra. So we have one brand under ROST and we have 5 brands under TJ Maxx. Now, also a good thing to know as we go through these numbers, Home Goods, HomeSense, these sell more higher ticket items like furniture and decorative items for the home. It's still a discount store. However, when comparing to ROST, they're going to have higher ticket items that they're selling on average. Also, Sierra.com sells discount items online. So there's going to be a greater opportunity for them to have a little bit higher margins for online sales compared to ROST that only sells in store. So keep that in mind as we go into it. So let's take a look. So starting out, we're looking at the revenues. We have ROST coming in at $20.3 billion versus TJ Maxx and their brands coming in at $54.2 million. Check goes there for TJ Maxx. So now let's look at the 5-year average growth rate. We have ROST at 8.79 and we have TJ Maxx growing over the past 5 years at 9.32. That check goes there for TJ Maxx. Net income, we have $1.87 billion for ROST, 4.4 coming in for TJ Maxx. Now, off first glance, it looks like, hey, TJ Maxx has more revenue, so they would get the check, but let's look a little bit deeper. Net profit margin, how much of the revenues or what percentage of the revenues are being turned into profit? We have 9.2 for ROST and we have 8.2 for TJ Maxx. So ROST is actually keeping more of their revenue as profit. Means they're a little bit more efficient looking at their operations, which is a little bit surprising knowing that you have a component or a brand that primarily sells online with Sierra. But there we go, we have ROST at 9.2. Now looking at free cash flow. Now free cash flow is very important because it is the amount of cash that a company generates within any period of time for paying down debt, paying dividends, acquisitions and mergers, also buying back shares and reinvestment into the company. So this is a very, very important number here, important metric. My favorite to look at, the free cash flow that the company generates. We have 1.75 billion for ROST and we have 4.34 for TJ Maxx. So they are generating a lot more cash flow. Now, also to note, we have different size of the companies, 20 billion versus 54 billion. So even though this company is bringing in less cash flow, they're still bringing in a solid percentage. But just for the sake of this comparison, we'll just give the nod to TJ Maxx since it's larger. Now let's look at the 5-year free cash flow annual growth rate. We have ROST at 6.5 and TJ Maxx at 16.4, growing that cash flow at a much higher rate. So that's a great thing that we want to see. Looking at the balance sheet, let's look at cash. We have 4.8 for ROST and we have 5.6 billion for TJ Maxx. Now, given the size of these operations, I'm gonna give the nod to ROST. 4.8 is a much higher percentage of the revenues than 5.6 at 54.2 billion dollars of revenue. So the cash that they're holding on is much higher and much better when you're looking at the operation. So now let's look at debt. 2.2 for ROST, 2.8 for TJ Maxx. Now, very close. We're only looking at about 600 million difference. But again, looking at the size of the operation, that's a better debt balance for ROST versus TJ Maxx. Now, another important metric when you're talking about debt, the amount of debt doesn't really matter as much as how fast can they pay that debt off. So I look at debt to free cash flow. That number lets me know how long it takes for that company to pay off their debt. So looking at the free cash flow that they're generating compared to their debt, ROST can pay off their debt in 1.3 years. TJ Maxx can pay off their debt in 0.7 years. Now, When it comes to debt to free cash flow, anything under 3 years is great. Anything under 5 years is manageable. Depending on the situation, you may not want 5 years. You may want to stay under 3. That's definitely a safe zone. Since they're both under 3 and they're close, 1.3 to 0.7, that's a tie in my opinion. Nobody really has an edge there. So looking at the metric that we use for retail stores specifically, or retail brands, revenue per square foot. This is going to let me know how efficient the company is when it comes to their distribution centers and their retail space. So the stores that they have, plus their distribution centers where they're gathering all their materials and distributing out to all their stores. We look at the square footage over all of those stores and we find out, compare that to the revenue and find out what their revenue per square foot is. And now looking at their revenue per square foot, we have ROST, $333 of revenue per square foot of space when it comes to the distribution centers and retail spaces. And TJ Maxx, $722 per square foot. So the nod goes there. But remember, as we mentioned before, you have online brand with Sierra and you have Home Goods and HomeSense that has, on average, a higher ticket item. So this makes sense that they have a much higher revenue per square foot versus ROST. So TJ Maxx gets a nod there. Now let's look at their growth estimates. So I went to Yahoo Finance to look at what analysts are saying as far as their growth rate for the next 5 years. So the average of all the analysts' opinions, 14.79 for ROST, 10.52 next growth rate for the next 5 years. ROST gets the nod there. The PE ratio, we have ROST at 23.8 and TJ Maxx at 25.9. So the PE ratio doesn't mean anything by itself. This is why I like to look at the price to earnings growth ratio, the PEG ratio, that lets me know what the PE ratio is compared to their estimated growth rate. And the reason this is important is because when you're buying a stock, you're buying the future growth of the company. Lots of people like to buy a company that's been growing fast, and that's great. We look at past trends to anticipate what the future trends are going to be. But when you buy a stock, you're not buying the past success. You're buying the future success of the company. So we want to look at the PE ratio, what the price of the stock is compared to the earnings, also compared to the growth of the company. So we have 1.6 for ROST. We have 2.5 for TJ Maxx. Now, both of these ratings are technically overvalued. Now, for this ratio, anything that is fairly valued is going to be between 0.7 to 1.3. Anything over that is considered overvalued. With that knowledge, we say that TJ Maxx is definitely overvalued compared to ROST when you're looking at the current price compared to the growth rate of the company. So ROST gets the nod there. Dividend, we have 1.1 for ROST and 1.5 for TJ Maxx. Pretty solid dividends. The payout ratio, 25.9 for ROST, 34 for TJ Maxx. Now, these are a tie because these are both great payout ratios. And also to know, when I look at the payout ratio, I compare the dividend that's being paid out compared to the free cash flow. So many people look at the dividend compared to the earnings for the payout ratio. I like to look at the free cash flow because that's the pot of cash that the company generates that they pay the dividend out of. So it's important to me to compare the dividend payout to the free cash flow. So we have 25.9 of the payout ratio for ROST and 34% of the free cash flow paid out in dividends for TJ Maxx. Again, anything under 50% is a good range for companies that you're looking at when it comes to dividend growth, for dividend growth stocks. Now, one thing to note, both of these companies are growing their free cash flow. TJ Maxx much more significantly than ROST over the past 5 years. That's not necessarily an indication of what the next 5 years are going to be. Remember, we have a higher estimate for growth in the next 5 years for ROST. So both of these companies are growing their cash flow and should be able to have plenty of runway to increase the amount of dividend that they're paying as time goes on. So both of these companies are great dividend plays, in my opinion. So after looking at this analysis, we have 7 checks each for both companies. So it looks like it's a standoff. As far as this comparison, if we were to do a tiebreaker, I would go with ROST just because of the estimated growth rate and the better valuation and the lower payout ratio. These three things, to me, based on my investment style, I would go at ROST over TJ Maxx because of these three factors. Again, growth rate, valuation, payout ratio. So I hope you enjoyed this comparison. I plan on doing a whole lot more. In the comments, let me know which companies you would like for me to do a comparison of in the future. So see you in the next video.